Britain's finance minister, who has faced criticism for travelling to China during market turmoil at home, said on Saturday pragmatic and predictable relations with Beijing would help boost growth and trade. Rachel Reeves was on a 2-day trip to revive high-level economic and financial talks that have been frozen for nearly 6 years. Under fire because of a sharp rise in British interest rates, Reeves also defended her latest budget.
The fiscal rules that I set out in my budget in October are non-negotiable, and growth is the number one mission of this government, to make our country better off. And that's why I'm in China, to unlock tangible benefits for British businesses exporting and trading around the world.
Last year, British Prime Minister Keir Starmer, elected in July, and Chinese President Xi Jinping launched the first dialogue between the two countries' leaders since 2018. Reeves said re-engaging with China would deliver trade worth $730 million to the British economy over the next 5 years. China is Britain's fourth largest trading partner. Starmer's aim of boosting trade with China may become more difficult if US President-elect Donald Trump follows through on his threat to impose tariffs on all imports. Asked whether Britain would follow Washington and Brussels in imposing tariffs on Chinese electric vehicles, Reeves said British car manufacturers export substantially to Chinese markets and that Westminster would take decisions in the national interest. Britain's interest rate rise, due in part to a global bond sell-off, has drawn comparisons with the 2022 mini-budget crisis that forced then Prime Minister Liz Truss out of Downing Street. However, this week's market moves have been less sharp, and there's so far no evidence of that level of strain on institutional investors.
China's exports accelerated last month, while imports also slowly recovered. It was in part driven by factories rushing inventory overseas as they ready for bigger trade risks under a Donald Trump presidency. Exports have been a vital growth engine for China, a bright spot for an economy still hurt by a prolonged property crisis and low consumer confidence. Customs data showed Monday outbound shipments in December rose 10.7% year-on-year, well above analyst projections and November's reading. Imports surprised to the upside with 1% growth, the strongest performance since July last year. Economists had expected a decline. A Chinese customs spokesperson told Reuters there was still huge room for China's imports to grow this year. Analysts said a weakening yuan helped Chinese manufacturers find buyers overseas last year. China's exports grew by an annual 5.9% last year, while imports increased just 1.1% over the same period. Looking ahead, US President-elect Trump has proposed big tariffs on Chinese goods and raised fears of a renewed trade war between the two countries. Beijing also faces unresolved disputes with the EU over tariffs on Chinese electric vehicles. It threatens to hit China's ambitions to expand its autos exports and help address deflationary overcapacity concerns. Market reaction was muted to Monday's trade data. The yuan hovered near 16-month lows against the dollar, while key share indexes were down.
U.S. stocks sank on Friday, with the S&P 500 erasing its 2025 gains after an upbeat jobs report stoked fresh inflation fears, reinforcing bets that the Federal Reserve will be cautious in cutting interest rates this year. Wall Street's main indexes closed their second consecutive week in the red. They finished Friday's session off more than 1.5% each. Most of the 11 S&P 500 sectors declined, as did 6 of the Magnificent 7 mega-cap technology stocks, with only Meta Platforms climbing about 0.8%. The Labor Department said the economy added 256,000 jobs in December, far above estimates, while the unemployment rate fell to 4.1% from 4.2%. A hotter-than-expected job gain could signal faster economic expansion and therefore a rise in prices. The Wealth Alliance president and managing director Eric Ditton said that could mean no interest rate cuts at all in 2025.
The Fed will probably not cut rates anywhere near where the market thought it would just a few months ago. A few months ago, we were expecting a good 4 cuts in 2025. And my opinion, we're probably not seeing cuts anytime soon. We may not see a cut this year if the economy continues along this trajectory.
In fact, Bank of America Global Research is now forecasting a potential rate hike. However, Chicago Fed President Austin Goolsbee said there is no evidence the economy is revving up again, adding he still expects it will be appropriate to lower interest rates further. Other stocks on the move included Corona beer distributor Constellation Brands, which fell 17% to its lowest level in more than 4 years after cutting its annual sales and profit forecasts. And shares of Walgreens Boots Alliance jumped 27.5% after the company reported an upbeat quarterly profit.